Hello everyone, I'm Roger Conrad and welcome to my presentation, What's Next for REITs? REIT Strategy for High Yields and Reliable Growth. This is the latest of twice annual presentations I do to supplement our sector coverage in the REIT sheet. By this time, I hope everyone has received the most recent quarterly edition of the advisory, and hopefully everyone has had time to look it over at least a bit. I intend to use what's in the latest REIT sheet as a jumping off point for this presentation. I also want to remind everyone that the heart of each issue is the coverage universe table at the end of the report, tracking performance and prospects of each REIT we track. That includes, of course, risk ratings and buy, hold, sell advice, and also analysis of each company's Q4 results and outlook in the comments column. Also, before I get started, I want to thank everyone who sent questions in earlier this week. I will be answering them following the conclusion of my prepared remarks. If you are unable to send yours in on time, the final slide in this presentation has information on where you can contact me in the future. By way of a preamble, REITs or real estate investment trusts have been a staple of conservative income-driven portfolios really since I've been in this business, which dates back to the mid-1980s. They're a unique corporate structure that allows companies to pay out the vast majority of their earnings as dividends and on a tax-advantaged basis. When I first started tracking REITs, they were pretty much focused on traditional real estate, such as apartments, retail shopping centers, and malls, office buildings, and the like. But as you peruse the data bank I've developed for the REIT sheet, you'll see companies from a wide range of non-traditional sectors are now organized this way, including businesses like data center owners and wireless tower operators that quite literally didn't exist back then. I'm still tracking plenty of owners of office buildings, shopping malls, and the like these days, and in fact, this is where the big gains have been in the sector since my previous presentation, which was back in September of last year. But we definitely have a much greater variety of high-yielding REITs to choose from now. And while there haven't been that many IPOs recently, I think we will see more going forward as dividends popularity and the likelihood of higher corporate taxes convinces more businesses that they can raise capital more effectively under a REIT structure than as a C Corp. I do continue to believe that not every business should be a REIT, paying out such a high percentage of its cash flow in dividends. And it's incumbent on investors to avoid them. And that's one way this service can be especially useful. But with the vaccines rolling out and promising to roll back the pandemic, this is a great opportunity to buy high quality, high yielding, exceptionally reliable properties, and right now. Here are my key objectives for this briefing. First, I want you to walk away from this with a clear knowledge of what's been happening since our previous update in the REIT sector. I'm going to identify the key drivers and risk for the rest of 2021 and beyond, and with a discussion of REIT sectors as well as individual REITs. We'll then take a look at strategy, including how I'm identifying the best buys now. That will be followed by a discussion of the 12 favored REITs on the REIT sheet recommendations list. And lastly, I'll be answering questions emailed to us in advance of this presentation. Again, today's discussion will be largely expanding on what I wrote in the REIT sheet, so be sure to check that out as well as the REIT sheet coverage universe table at the end of the issue. So let's dig in here. My next slide compares 6-month price performance, actually 2-year price performance. Well, actually 6-month price performance, basically the time since my September REITs presentation for 3 REIT securities. The blue line is the iShares US REIT ETF. It's up around 18% over that time frame. The black line is Simon Property Group. That's the largest US shopping mall REIT, which is up about 83% over that time frame. And the red line is Wireless Tower and Infrastructure REIT American Tower Corp, which is actually underwater by about half a percentage point over this time period. Why am I showing you this? Well, there are basically 2 reasons. First is to show you the wide divergence in 6-month performance between individual REITs and property sectors. Second is to show you how that hurts your returns when you choose to buy ETFs over doing your own stock picking. Like most sector ETFs, the iShares is broad-based with 85 holdings, and it mirrors the Dow Jones US REIT Index. It's also heavily weighted toward the REITs with the highest market capitalizations. That's typical of most indexes, and it does make a certain amount of sense. Mainly, the companies with the biggest market caps tend to be the companies with the largest underlying businesses in a sector, and how they fare, in other words, tends to be a much better indication of the health of that sector than the performance of a smaller company. On the other hand, some companies have big market caps simply because they're investor favorites, and their stocks have run up the most if the market is rallying, or at least held up the best in a sell-off. The iShares ETF holds both American Tower and Simon Properties. But before its most recently quarterly rebalance, it owned about 4 times more American Tower than Simon. And even now, 8.4% of the ETF's assets are in American Tower, and that's versus less than 3% for Simon, which, though it's the largest, quote, traditional REIT in this index, is actually just the 7th largest holding overall. It might also come as a surprise to you that there are actually no residential or office REITs in the iShares ETF's top 10 holdings. There's only Avalon Bay Communities at number 10 in the slightly less popular Real Estate Selector Sputter ETF, which is based on the Real Estate Select Sector Total Return Index. The Sputter actually has more than 21% of its holdings in just 2 securities, both wireless tower operators. That's American Tower and Crown and Castle. And if you throw in data center REITs, Equinix and Digital Realty at numbers 4 and 5 respectively, that's more than 1/3 of this ETF's portfolio in just 4 companies, all non-traditional REITs. Now, there's nothing inherently wrong with any of these companies other than possibly very high valuations. In fact, as I noted in the current issue of the REIT sheet, after recent underperformance, American Tower shares are again buy rated. But the heavy focus on non-traditional REITs has prevented these REIT ETFs, and pretty much every other REIT ETF you can find as well, from really participating in what's been a massive recovery for traditional REITs like Simon Property, which, as you can see from the black line, has really been off to the races since we highlighted it in the REIT sheet as a top recommendation. And the lesson here is, if you're going to bet on a sector, picking your own stocks, in this case REITs, is really the only way to go. In recent months, I've laid out our view that REITs on the whole were due for a big recovery for several reasons. A likely shift in the preferences of the big pools of capital that dominate daily trading from, quote, growth to, quote, value was a big one, as the pandemic recedes and the word cyclical loses its current negative connotation. I wasn't expecting miracles, just for the laggards to at least start to close the gap with what were then the leaders. That started to happen over the last 6 months, and the result has been a rally in REITs across the board. The ETF shown here hasn't done a horrible job of capturing those gains, but again, the difference between performance of Simon and the iShares ETF is more than 60 percentage points over these 6 months. The gains for Avalon Bay, which is another REIT we featured in the REIT sheet, are more than twice those of the Select Sputter ETF, of which it's the 10th largest holding. I do think REITs still have the macroeconomic winds at their back. That starts with the massive stimulus, both monetary and fiscally, from the US government, and the rollback of the pandemic as more vaccines get into more arms in this country. But property is also now starting to become part of the discussion about what's next after the pandemic and the inflation that we could see as growth accelerates. Mainly, property is a traditional inflation hedge. And more than that, REITs offer high current income when really all growth stocks can basically offer is future cash flows. And in an inflationary environment, the net present value of those cash flows diminishes, which in turn increases the appeal of current income for investors that REITs have to offer. So I think REITs as a sector are going higher, and quite a lot higher. But again, and this is a point I've made in previous presentations as well, it's the stock picker who is going to get the best of the gains. All the ETF holder can do is hope the good stocks within are more numerous than the bad and the ugly ones. And don't forget that not every REIT is out of the woods yet on pandemic pressures. We had 2 more dividend cuts in our coverage universe since the previous REIT sheet went to post. And the risk of more rises every day the U.S. economy is running at less than full potential. So let's take a look at some of the reasons behind the divergences in REIT performance. This next graph is actually 4 pictures in one, so there's a lot to digest. But starting in the upper left-hand corner of this slide is a brief barometer of the health of the office property sector. These are the major cities that had the highest vacancy rates as of last month. That 15% you see for the entire U.S. is also quite elevated. Obviously, not a lot of people are going to work in offices right now in the U.S. And from the various straws in the wind that I see, that's likely to be the case for at least much of this year, despite the accelerating pace of vaccination. One thing I found when checking out individual office property REITs' Q4 earnings and guidance, and you can see the highlights of this research in the table of the REIT sheet, is that overall occupancy rates are actually still pretty solid. Most did see some declines, but big office REITs like New York City-focused SL Green, which is a REIT sheet recommendation, are in fact still pretty close to pre-pandemic rates for tenants maintaining their space, even though not a lot of people are going in there and haven't been for a while. What suffered for these REITs has been their retail tenants, since obviously no one is frequenting the building coffee shop. And those revenues have dried up, but the office tenants, which are the real bread and butter of their business, are still keeping their leases, and they're paying their rents on time. And for the most part, they're renewing expiring leases, in most cases paying higher rents to do so with few or any rent concessions. That's made this business actually very stable during the pandemic year, and the expectation is these REITs will actually get stronger as the pandemic is rolled back and companies start centralizing work again. I'm pretty confident that's going to be the experience of SL Green as well as some of the other leading REITs, especially for the office REITs that occupy favored specialty areas, as REIT sheet pick Alexandria REIT does in the health sciences. But I'm not at all sure about the sector as a whole. I think we're just going to have to see how many businesses decide it's worth their while to shrink their common space and reduce expenses by allowing more working from home post-pandemic than they did prior to 2020. And I do think some office REITs are going to feel some pain with more vacancies and almost certainly rent concessions to keep spaces filled for the next few years at least. The lower left-hand graph has become something of a perennial in these presentations. It shows how various REIT groups held up during the previous recession in 2007 to 2009. I keep repeating it because it provides a good point of comparison with what's happened the past 12 months. It's still true that the groups that did worse last time have done so again this time. That includes lodging and resorts, more commonly known as hospitality now, which have been absolutely blasted by the combination of reduced business travel spending, COVID-19 closures, and the continuing reluctance of Americans to vacation and stay in hotels and resorts with a pandemic on. Resorts, rather. A supportive Fed last year enabled mortgage REITs to avoid the mass bankruptcies the sector suffered in 2008. But we nonetheless saw massive wealth destruction that did deep damage to the earning ability of more than a few portfolios, as managements were forced to liquidate assets to cut leverage. And this is one of the REIT groups that makes me most nervous now regarding the post-pandemic environment, as they're likely to have to manage funding costs that are rising faster than our returns on new mortgages. Industrial REITs are still a success story, just as they were 6 months ago, as I discuss in the REIT sheet. And not only are industrial occupancy and rent collections really holding up, but the leaders are clearly now in expansion mode. And eventually that means a lot more dividend growth for industrial REITs overall. Healthcare remains a mixed bag, with single-purpose medical and research landlords thriving, and senior lifestyle facilities still seeing rapidly declining occupancy rates. I really do think that the senior lifestyle facilities group has suffered reputational damage that will be very, very difficult to overcome in coming years. And their loss is shaping up as a potential gain for some REITs like Equity Lifestyle Properties, also in our coverage universe. That's a landlord for camping grounds and seasonal resort communities, as more seniors decide to spend their golden years in more festive places than conventional retirement homes. If there has been one big change in the last 6 months, it's been that the self-storage business has started acting a lot more like it did in previous recessions. That is, landlords are now seeing strengthening rents and occupancy as well as higher collection rates. And that's been quite beneficial for the storage REITs in our coverage universe. Turning to the other side of the slide, the top right-hand graph tracks the narrowing spread between rents in major cities like New York and San Francisco, which had been quite high, and urban areas in the rest of the country, which had comparatively been quite low. This trend was already set in motion before last year, simply because rents had gotten to such high levels in the big urban areas. But it's absolutely accelerated during the pandemic, with the result that the price gap is now the lowest in years. The subtext here is there's been more or less a bifurcated market in residential properties in the U.S. over the past year, and a correspondingly sharp difference in performance between apartment REITs focused on the largest cities, which has been relatively poor, and those more weighted toward the Sun Belt and Midwest, which has been relatively good. A good example of a second group being REIT Sheet Pick Mid-American Apartment REIT, which you can read about in the REIT sheet. The Sun Belt continues to outperform on key metrics like occupancy, rent growth, and rent collection. We have seen a big recovery for the more battered names in the urban space, though, but it still pays to be a bit cautious on how much we pay for names like Avalon Bay while we wait for their business performance metrics to turn the corner, and they still have not yet. Finally, the graph in the lower right-hand corner is more or less a tracker of sentiment the past 15 years or so for various property types. It was at first a bit of a surprise to me to see that the mood was a lot darker actually in 2007 to 2009 than it was last year. But on reflection, this is pretty much what we saw in the broad stock market as well last year. Mainly the sell-off of February and March 2020 was pretty broad and deep, but it lacked the duration to be considered on the same page with the 2007-2009 bear market and financial crisis. It just didn't last very long at all, as that bear market did. Avoidance of a real bear market is hopeful for a commercial real estate recovery in general, though as I've said, not every property type is as leveraged to the recovery, and some still face considerable adversity this year. So let's turn to our REIT investing outlook, which is highlighted in a series of summary points on my next slide. First off, the REIT rally so far has tended to favor large, big capitalization names like Simon Properties, Avalon Bay, and so on, actually regardless of business type. That's pretty typical, actually, of recoveries. When investors are sticking their toes back into a sector or stock market that's taken a big hit, they're always going to look first at the names they're most comfortable with. And with few exceptions, those are going to be the leading companies they're familiar with, even again if the hit to the underlying business has been massive, as it certainly was for Simon's shopping malls. Remember that Simon actually cut its dividend by more than 1/3 last year to hold in cash. And the shopping mall industry, while looking a lot better now than it was 6 months ago, is hardly in the pink of health. I make this mainly as a cautionary point. As you can see it in the changed advice of the 4 names in my REIT sheet recommended list that now rate holds, three of them actually I've moved to hold, and one of which, Brookfield Property, I'm actually recommending selling at this time. In Brookfield's case, the sell is because the stock is now fully priced to the takeover offer its parent, Brookfield Asset Management, has put on the table. For the rest, it's because I believe big cap fever, in other words, buying the most familiar names, has run their prices ahead of where they should be based on the most recent business performance metrics, which, for all of them are at Q4. Get another Q1 set of results for Q1 in spring. But right now, based on what we see in Q4, they've run ahead of where they should be based on their business performance, based on their actual recoveries. Bottom line, a lot of good news that hasn't happened yet is already priced in. And the numbers are going to have to get a lot better for these REITs to be worth meaningfully higher prices. Our fresh money, until then, is going to be better off going to names where either the numbers have already improved substantially or where share prices are still lagging behind. The second point is numbers are indeed starting to improve remarkably for more than a few REITs. In fact, Q4 results and guidance for more than a few showed a degree of resilience I frankly had not expected to see at this point. That's the primary reason why you see a lot more buys in the REIT sheet table than there have been really at any point since I started this advisory a couple of years ago. Certainly not everything is a buy, and the real stragglers are still sells, but this is a very positive change from where we were 6 months or even 3 months ago. Very, very positive for the REIT group in general. I won't belabor the third point, which is basically just to say that there's been a big difference in REIT performance since my last presentation, and it's practically certain there will be over the next 6 months as well, meaning some REITs are going to do great and some probably not so great. So stock picking, again, as we look out for the rest of 2021, stock picking is still the way to go. Points 4, 5, and 6 highlight the criteria we use to determine what are the highest quality REITs and how much we want to pay for them. Again, I won't elaborate too much on these. If you're interested in a deeper explanation, there is a discussion in the last section of the REIT sheet before the tables. And if you want to see how particular REITs stack up, the table is the best resource I know of, featuring the best of my research. But suffice to say that when a REIT comes out of this process as a buy, it's for a lot of very good reasons. And what you have is a company that's proven its resiliency in the worst possible circumstances, meaning last year, is poised to ride the recovery we expect to see more unfolding this year, is paying a generous dividend that's likely to go up over and consistently over time, and is actually trading at a fair price, which, as you know, is unlike most of this high-priced stock market. There are REITs I think will outperform the REIT sector and the overall stock market for the rest of this year, but more important is the fact I believe you can buy and hold them with confidence for the long term, which I define for investment purposes as the next 3 to 5 years at least. What about the outlook on the various sectors? Every REIT sheet features a discussion of the various property sectors, including the major developments since my previous REIT sheet, my outlook, and what to buy and what to avoid. My view is we're not fully out of the woods yet on this pandemic. The impact on businesses using the REIT model has varied widely over the past 12 months, and that's basically the point of this slide, which sums up how various REIT specialities are faring with the pandemic, still the single most important factor affecting occupancy rates, rent growth, rent collection, and property values. As I said last time, you should use the table on this slide here 2 ways. First, as a gauge of risks each of these subsectors carries broadly, and second, as an indication of which sectors are likely to bring the biggest gains when the environment turns. Don't assume every REIT in the subsector is a good buy or a safe income investment, while those in another are all too risky. And don't base your choices on the assumption REITs in one subsector will continue to out or to underperform. Over the last 6 months, for example, that would have led to actual losses in some formerly red-hot sectors like telecom, wireless REITs, data infrastructure, and you would have missed sharp recoveries in the better names in retail and residential REITs. The game here is really all about making the right choices within these subsectors. And as the previous slide noted, there are multiple other factors that determine company quality and value, including leverage and balance sheet strength, tenant quality, lease structure and length, the age of primary properties, and regulatory concerns. I'm going to run through the next several slides relatively quickly. There are 2-year price graphs of several REIT subsectors, starting with the Bloomberg Regional Mall Index. This one is heavily weighted toward the biggest U.S. mall owner, which I've discussed at length already in the presentation, Simon Property Group. This group took a huge hit when it became clear the pandemic would force shopping mall closures. But it's since rebounded massively, and especially since November when the news hit that not one but several COVID vaccines were on the verge of launching. And of course, that's played out even more so over the past few months. It's become clear leaders like Simon have proven resiliency and will benefit greatly as the pandemic's worst effects recede. But while the mall index is still trading well below its pre-pandemic levels, investors should be aware this group has come a long way in a short time, and that performance metrics, the actual business performance metrics, haven't yet caught up to these price gains in the shares. Bottom line, if you bought into Simon and other regional mall REITs last year, pat yourself on the back, hold what you have. But those looking to invest fresh money should wait for either more of a pullback or some blockbuster Q1 numbers. And Simon's will be out in mid-May. That's what I'm expecting. I'm expecting to raise the buy target for Simon. But again, we haven't gotten to that point yet. The next graph is the benchmark Data and Infrastructure Real Estate Index, which is roughly 50% in three wireless tower companies: American Tower, Crown and Castle that I've mentioned earlier, and SBA Communications, as well as data center REIT Equinix. I track all these in the REIT sheet. These REITs rebounded quickly from the February-March 2020 sell-off, as they really behaved a lot more like technology stocks than REITs. But since then, they basically run in place, and some former leaders like American Tower have actually lost ground. It's not that wireless towers have shown any real business weakness. In fact, I'd argue American Tower has actually made a number of moves that significantly enhance shareholder value over the last 6 months. That includes accretive acquisitions and dividend increases. But when valuations get as high as they were last year, it's simply very, very difficult to make any real headway. And that's what we've seen in the performance of these stocks. The silver lining to this underperformance is that there are several names that have become a lot more interesting, even from a valuation standpoint. That includes American Tower, as I've mentioned before, and also data center REIT CyrusOne, which is on our recommended list as well. But investors should remember these REITs move to a different drummer than traditional REITs. Data centers like CyrusOne, for example, are in huge demand, but have also become a much more competitive business, which means leaders are always at risk to sell-offs, pretty much following every quarterly report if the results don't measure up. Traditional REITs tend to have much greater ability to shake off whatever's reported. They have more of a cushion because, again, lower valuations and bigger dividends. My next graph is the Bloomberg Office REIT Index. I've already highlighted my macro outlook for office REITs in this presentation. Suffice to say, this is a group I think investors should be especially selective in at this point. The graph shows a second retreat in this index last autumn that took it almost back to the March 2020 low. That was followed by a sharp rise in November following the vaccine news. And there's a growing consensus we're going to see more gains in office REITs as vaccines enable companies to return, again, to more centralized work environments. Again, I wouldn't argue with that forecast. In fact, as I discuss in the REIT sheet, and I have discussed earlier in the presentation, I've actually raised the highest recommended entry point for SL Green, the New York office building company, because of that increasingly positive outlook. But I also think the pandemic will leave its mark on this sector in a more permanent way, as at least some companies will determine they can get by on less centralized office space and pocket the savings. So while I like some office space names, I've mentioned SL Green again and Alexandria Real Estate Equities, which owns a portfolio of medical research facilities, I'm actually very cautious on most. The Bloomberg Real Estate Investment Trust Residential Index, shown on my next slide, has 19 members, the largest being Avalon Bay. As I noted earlier in the presentation, the rift in this sector over the past year has been between REITs focused on urban area apartments and residences and those with portfolios mainly based elsewhere. The more urban REITs have taken a big hit over the past year, and they'll likely continue to well into 2021 on an earnings standpoint, as the impact of reduced rents to pump up occupancy that's been made in the past several months starts to show up in earnest at the bottom line. The REITs operating elsewhere, in contrast, have done well as businesses, largely living up to their reputation as among the steadiest performing sectors during economic downturns. What's tricky is both sets of apartment REITs have been a part of that surge you see in the last 5 months or so shown on this graph. And that means investors need to also be very careful here about what they choose for fresh money. Not so much because there's impending doom for any of the major names, including the urban REITs, but because some of the big ones like Avalon Bay appear to have gained a lot more ground than their business numbers would seem to justify to date. Again, their Q4 numbers. And that may change in Q1, but right now they're a little bit ahead of where they should be at this point in the cycle on a valuation standpoint. Bottom line, the environment is getting better for residential REITs, and even the hard-hit urban REITs like Avalon Bay are proving their resilience. But more than a few sector stocks appear to be out over their skis a bit, to borrow a Canadian term, in terms of price. It will be hard for them to advance meaningfully until the numbers improve. So watch the prices before you commit fresh funds. Of course, no REIT presentation of mine would be complete without turning your attention briefly to Canada. If you've had a chance to read over the REIT sheet, you'll notice we have several Canadian REITs on our focus list. And I don't like every Canadian REIT we cover in the REIT sheet databank for reasons explained in the comments, but I do like these. First, Canada's rent mitigation plan has been a huge success to date. Basically, the government covered 50% of rents for successful applicants for its SECRA program, with landlords and tenants splitting the rest equally. The result has been most Canadian REITs avoided a big drop-off in rents, rent collections, and occupancy last year, and now even the hardest hit are seeing sharp improvement in all three metrics as tenants increasingly no longer need any kind of assistance. Second, Canadians run REITs more conservatively than their U.S. counterparts. I realize that's a gross generalization, but we saw the positive effect from that once again last year as only a couple Canadian REITs we cover were forced to cut dividends. The trade-off is restrained dividend growth in good times, but this is generally a group with safer payouts. The Canadian dollar was also a solid plus for us the last 6 months, rising from about 73 US cents to 78 US cents. I think the currency is only going to get stronger in coming years, in part because the energy price cycle appears to have turned higher. If you're a subscriber to our Energy and Income Advisor, you'll soon see a major article on the long-suffering Canadian natural resource sector. Though I've covered these companies for years, this is our first EIA feature piece on this area for some time. The reason we've chosen to do one now is there are some pretty clear signs of stabilization and eventual recovery. So while this sector's struggles are still a net negative for Canadian REITs now, my view is this won't be for very long. There's still the possibility of an election in Canada sometime in the next few months, which could bring uncertainty. But ironically, it could also bring more certainty, since the only reason one would be called would be if the current PM sees an opportunity to win back a majority in Parliament. In any case, the Liberal Party government has generally been a positive force for REITs, with the SECRA program the clearest example. I discussed the last point here about tax withholding and OTC listings in the REIT sheet, but before we leave Canada, I wanted to show you a performance graph for the country's REITs. Again, this is a 2-year graph, and so it shows the huge decline about a year ago, but it does contrast with our other REIT subsector graphs in one key respect. That is, the recovery has been a lot steadier. Big jump in March and April when the government announced the SECRA program, and another jump in November on vaccine news. But aside from that, just a general progression upward. I think that really points to the steady business performance of Canadian REITs as they prove resilience, and the government supported them with SECRA. And I think it bodes very well for the REITs we've recommended for the rest of 2021 and beyond. So that's it for our sector discussion. Let's take a look again at what differentiates a high-quality REIT from, Well, one you don't want to own. This slide highlights 5 criteria we use to make that determination. Going into this pandemic, we did have a pretty clear idea of REITs' balance sheet strength. There was information on how exposed their cash flow was to past downturns in the economy and property markets, and we could look at management's history to get an idea of who was experienced in dealing with crises. What we didn't know exactly were the specifics of how businesses would be affected by the pandemic, how governments would respond to the fallout, particularly in an election year, and above all, how well REITs would be able to adapt to what was happening. Well, we do have those answers now. First, best-in-class companies have been able to weather government actions, including eviction moratoriums and other quarantine measures like shutting down shopping malls. The results of the U.S. elections haven't really affected much in the REIT world either, and while it remains to be seen what happens to senior living facilities' long-term prospects, even in this sector, the legal risks resulting from COVID-19 appear to have been overstated. So that's a lot of good news. Most important, though, actual business results, not politics, have been the most important drivers of returns over the past year. And companies demonstrating the most strength and staying power based on the operating and financial criteria we use have fared the best. So where are the best buys now? As I said earlier in this presentation, the REIT sheet features a recommended list of the top buys. And this slide lists the 12 currently there and recommended as buys, along with some of the data shown in that table. I'm not going to spend too much time on this slide since each of these REITs is highlighted in the REIT sheet text and especially in the data bank. But I do want to make 2 general points. First, all of these REITs are suitable buys for fresh money now. I do rate them as either, quote, conservative, aggressive, or speculative based on the criteria I've discussed in this presentation and it linked in the REIT sheet. But the most important thing to remember is that diversification and balance are actually far better ways to control your portfolio risk than trying to parse out which particular REIT is the most aggressive or conservative. Or to put this another way, the effective risk of owning 5 aggressive REITs is actually less than piling all your funds into just one conservative REIT. My second big point is this list pulls from multiple REIT subsectors. There are some I've excluded, with mortgage REITs and seniors' homes, 2 examples. I also recommended avoiding hospitality REITs for the time being. There are no yields in this sector. There's no firm date for when traffic will return to pre-pandemic levels, or if it ever will. And as you can see in the REIT sheet coverage of the individual names, there are too many hospitality REITs bleeding cash right now. In fact, pretty much all of them are now, there's more cash going out the door than is coming in. It's obviously not a sustainable prospect. It will change at some point, but at this point, it's highly dangerous. They're relying on outside funds just to keep the doors open. I do have shopping malls, single-purpose healthcare facilities, New York City offices, data centers, and urban residential properties represented in our recommended REITs. What you choose should depend first and foremost, though, on individual business quality concerns. And I believe I've given you the tools to make that decision in the REIT sheet and in this briefing. Note that the rating column shows the highest price at which I'd recommend entering. Anything below that level is attractive, but don't chase REITs above those prices either. Payout ratio is the Q4 dividend as a percentage of recurring funds from operations. In general, lower percentages are better for dividend safety, but keep in mind, it's what's behind those payout ratios. Rent stability and growth, occupancy, and so on. That's what's much more important than the actual number. On a final note, I set these rating targets based on an expected 3 to 5 year annual return of 10% for the conservative rated REITs and a bit above that for the aggressive REITs. That's basically defined as yield plus expected capital growth. All this information on individual REITs, including whether they're conservative, aggressive, or speculative, can be found in the REIT sheet in the big table at the end, as well as in the expanded REIT sheet recommendations table. The final slide in my prepared remarks here is basically a list of some of the REIT sheet features that I've been discussing in this presentation in a little more detail. Again, I hope everyone has by now had an opportunity to check out what's in there, including the table, which again, I can't emphasize this enough. It's the heart of every issue with the company by company analysis. It's also where I have payout ratios for every REIT, and you can find those in the comments column at the end of the write-up. So this concludes my prepared remarks. Now let's move on to the questions we received from our investment community in response to the message I sent you earlier this week. Before I do, I want to thank everyone who did send in questions in time for me to answer them during this presentation. And I want to remind all REIT sheet readers that you can always send queries in between issues to the email address shown in this slide, which is service@capitalisttimes.com. So let's get into the nitty-gritty here with these individual questions. The first question is, I'm reading through your latest REIT report, which I really appreciate since I'm moving my portfolio to more income-producing stocks. You note that there's withholding of 15% that can be reclaimed as a credit on U.S. taxes, but I thought that if a stock is held in a 401k, then the withholding is waived. Is that the case for REITs as well? Well, in the case of Canadian stocks, the rule is that we don't withhold from retirement accounts from Canadians, and they don't withhold from retirement accounts for U.S. The problem here has been that many brokerage houses don't seem to be aware of this. So they go ahead and withhold the money anyway. So you are going to have to educate your broker. But this is one of the very few nice things, I guess, about investing in some foreign countries and with regards to the withholding tax. If you have a dividend that's paid by a Canadian company, including REITs dividends, paid by a Canadian company into a U.S. IRA, it should not be withheld. But again, you are going to have to check with your broker to make sure that you are being properly not withheld. Okay, so and here's another question here. This is about a REIT that's been buying properties in Vegas. It's called Vivi Properties, and I'm going to look that up for you here. It's not currently in our coverage universe, and in fact, it appears to be a Vici Properties. It hasn't been in our coverage universe. We will maybe look to put it there. Just looking at it briefly, it yields a little bit under 5%, which is a pretty attractive level. We do cover a couple of REITs that are involved in the casino business. For the most part, they've been collecting their rents on time, and that appears to be also the case with this one. I think any company that's been able to go out there, make acquisitions as this one has, that's got to be a positive sign. Again, I don't have a recommendation for you on it, but this will be one that we do look at for adding. And thank you for bringing it to my attention. I would pretty much just start it out, I guess, with a hold at this point. But again, we will have appreciate the bringing it to my attention. This is one we will look at in more detail. Okay, so moving to our next question here. I appreciate your analysis of REITs. Your recommendations of WP Carey, Washington REIT, Avalon Bay, and UDR, which is an urban apartment REIT, have all done nicely for me since October, so I'm glad of that. My request for you is whether your crystal ball is clear enough to select a few REITs in each of your conservative, aggressive, speculative categories, with a bit more potential for capital gains over the long term than the others. For the shorter term, the current price versus your maximum buy target provides an excellent guide. Well, thank you for that question. As I said in the presentation, main criteria that I'm looking for when I make these recommendations is not the short term. It is actually what I consider the long term, which is the 3 to 5 year time horizon. So anything you see that's recommended there, it's being recommended primarily for its potential over that time frame. That does include WP Carey. That includes Washington REIT. Although I did reduce the highest recommended buy target on Washington REIT, as you'll see in the REIT sheet, primarily because of some of the conditions that have been affecting it. Just basically the metrics. I don't think it's worth chasing all the way up to 25. Of course, that's actually kind of a moot point at this point because it does trade below 25. But in any case, I did ratchet that down. But I do believe all these names are going to be good for the next 3 to 5 years. I do think that we have had an opportunity over the last 6 months, certainly, really since Q1, Q2, at the bottom of this thing, we've had an opportunity to buy very good REITs at very good prices and to realize some pretty impressive short-term gains out of those. And that's been primarily facilitated by just buying these things at good prices. But again, we didn't buy anything that just on the basis that I thought we'd be getting a good 3-month, 6-month return out of it. All these, I think, have a lot of strong potential going forward. And if we just go back here to the recommended list, I'm just going to shift back here. I will go back to that last slide so those you can copy down that contact address. But just looking down here, I think what are some of the names? Just a brief comment on these. Artis REIT, it's in the midst of a restructuring right now, so I think that's already generating some pretty outsized dividend growth. But I think that's one of the names that could give us more in the near term than the long term. Alexandria REIT's probably I think one of my favorites certainly for a long term holding. Cyrus One. Again, all these are basically in there because of what they offer for a long term, from a long term standpoint. We're of course hopeful to capture some near term gains with them as well, but that's why we own. So hopefully that answers that question. Moving to the next question here. Again, some names that we do not have right now in the coverage universe. One is MAIN, which is Main Street Capital Corporation. It's basically one of the business development companies that has organized itself as a REIT. We do cover some of these. One of them is that has been rated a buy in the past is Hannon Armstrong Sustainable Infrastructure. I like this one a lot and I like it now that it's about $20 off of what its high was earlier this year. I like it a lot more. But the main reason I like it the long term is because it's in a great niche that has really proven its resilience in all kinds of environments since I've been following this company. It lends and invests in energy efficiency and renewable energy properties. Obviously an area that is seeing a lot of investment these days. This company's niche is basically loaning to or investing in entities that may have more trouble investing on a large scale. That's basically what business development companies do in general. Business development companies tend to have quite a few ups and downs with the business cycle. That comes from loaning money, again, to maybe not the biggest borrowers. Again, Hannon Armstrong's niche allows it to loan to much more creditworthy entities than the typical BDC. And that's a reason why, if you were looking at these BDCs, I would prefer that one to one like Main Street Capital, which is a more diversified type company. Now that said, this one's been a pretty good one over the years, paid a lot of special cash dividends. It's generally also held that monthly payout. So it's been very attractive from an income standpoint. I think, though, from a growth and income standpoint, we're better off with Hannon. But I will look to add Main Street um, going forward. Another name this reader asked about is Gladstone Commercial Corporation. It's another BDC. And again, all those things that I talked about with diversified BDCs do apply to this name. It does pay a monthly payout, which is attractive. It's a pretty high payout, but it's not immune from business cycles either. This one we will look at, though, to add as well. And again, I appreciate the steer here. And then here we're at Stag Industrial. That's the other one. And I did mention that industrial REITs, the industrial sector in general, has been pretty positive. And so this is one that we will also look to add as well. I think this is a sector where I did mention a few names in the REIT sheet. Would encourage this reader to check those out. But we will take a closer look at Stag as well. And again, thanks for that name. Moving along here, here's a question. Gentlemen, retired money for food and shelter comes from the conservative portfolio. We've weathered a great storm over the past several years. Your best recommendations have remained largely intact. Many thanks. I sense a new storm coming. It is here, money printing. Of that, we will see no end. Shall we say in the submarine service, how do we now rig for depth charges? How do I protect my income portfolio from rampant inflation? Sell 10% of it and place in gold and silver. As I understand it, oil has historically been a good inflation hedge, perhaps better than most. The income portfolio is real assets, real cash generating essential services. My sense is to shelter in place. Oil and gas is as good a place as any to weather the storm. Besides, I need the income. Please comment. So it's a pretty, I think, common concern of a lot of our readers. We talk a lot, we're kind of a bottoms up, I guess, service. We look at companies from the ground up. We want to get our primary purpose isn't so much to guess the macro trends here, but and try to anticipate them, but to buy the best possible companies that will give us that dividend growth, have weathered ups and downs, have a clear path towards that growth, balance sheet strength, and so on. And I think that is still an approach. Well, that's certainly the approach I'm comfortable with. It's an approach that served us well in all different types of environments. But this is, again, a question, and we realize that nothing exists in a vacuum. Dividend-paying stocks have to deal with the macro environment just like every other company. So, again, do we rig now for depth charges? How do we protect our income portfolios? I think over time, buying stocks that pay big dividends or have a clear path toward growth has been a pretty good inflation hedge. Oil and gas has certainly been a pretty good inflation hedge, or really anything to do with commodity prices. So if you didn't want to invest in oil and gas, you can look at big resource companies like BHP Billiton. That's a very good. The big oils have been a really good place for income investors, and as we move through what I think is pretty clear is an energy transition that's going to take a pretty long time. These are pretty good. These companies are in a really good place to take advantage of that, as they're big enough to basically dominate anything they touch in the energy space. And we're seeing a number of super oils, particularly in Europe, doing that. Total, that we talk a lot about, for example, has the franchise for electric vehicle charging stations in the Paris environs. So maybe not something a lot of people are aware of, but these big oils have the wherewithal to dominate energy regardless of what form it takes. So in the meantime, they're producing a lot of oil and gas, and that's tended to be a pretty good inflation hedge as well. So that's another good type inflation hedge. I do like the idea of some gold. I think that that can make a lot of sense. On the other hand, if for people that are needing income, that are living off their portfolios. Um, there are some gold investments that offer yield, but for the most part, it's other types of things that are going to offer you a bigger yield. So um, on the broader question, I guess, of should we really be protecting ourselves against severe monetary inflation? Um, I don't think it's ever harm to look down the road and see what could hurt you. Um, I remember, my dad grew up in the Depression and he managed his investments kind of in a different pots of money sort of thing. He wanted to have a lot of different places where there was income coming in, uh, where that would take advantage of different scenarios, or at least would hold up if one thing went bad. So he wouldn't have all his eggs in one particular basket. And I think that it does make a certain amount of sense. I'm not forecasting a new Great Depression, but certainly having that kind of mentality about diversification and balance, I think, is a tremendous help when we're looking at uncertainty. I don't think we've seen really any signs of inflation. I think there are other things right now that are big difference from the 70s, for example. It's very hard for me to imagine any kind of wage push inflation in the so-called gig economy, where workers really don't have a whole lot of ability to affect their wages. And as we saw with this pandemic, a lot of the economy right now, this gig economy, which sounds very groovy and everything, but is actually just basically a term for a euphemism for an economy where investor or companies can just lay off as many people as they want when they need to and hire them back on. So very good for companies, but again, not so great for workers. And I think it pretty much rules out any kind of wage push inflation. Could see some commodity push inflation, but again, I think it's a little early to talk about or think about some sort of great catastrophe. Even though as we read from Economics 101, loose monetary policies often do lead to inflation, and certainly did in the 70s. But at this point, again, just a broader answer to this. Think about that diversification. Think about that balance. Think about some of the things that do better in that kind of environment that will do what you need them to do right now, like the super oils and so forth, and some of these REITs too. I don't like the REITs that are organized around energy. I just think if you're going to buy energy stocks, if you're going to buy a REIT that's involved in buy a C corp or even an MLP, I think you're going to do a lot better because basically, you want to look at the underlying business strength. So I don't think there are a lot of choices in that, but there are in the REIT space. We're talking about property, and property has historically been a good inflation hedge, as I mentioned before. So again, think about these issues. Think about different diversification. I think that's a better way to look at things than, trying to batten down the hatches right now. And I do think the one thing that kind of scares me about the stock market is that we really haven't seen a real bear market since 2007 to 2009. So I'll just throw that out there. I'm not someone who thinks that February, March last year constitutes a bear market. In fact, if you look at a chart of the S&P, you can see a less severe but very similar shaped decline at the end of 2018. I think very likely we'll see another big decline along the magnitude. Prices are pretty high, so that's something we can protect ourselves against as well by holding a little cash around, taking advantage of that, as a lot of people did the big decline in February, March of last year. But again, that's kind of my macro view on that. All right, so another question here. Having just received the current REIT sheet, the long term, and this reader has done a pretty impressive 30% internal return on long-term IRR of 30% in the REIT sheet coverage universe. So congratulations for that. I hope that, we do continue with that. That's certainly our goal. Again, our objective, though, is going to be, um, basically a 10% return for the safer stuff that we have. And again, long term for us is 3 to 5 years, and that's the primary criteria um, that we're going to be using long term. So that I believe wraps up all the questions I have here. Just turning back to this slide here that I've continued to put up here. If for some reason you feel your questions were overlooked or not sufficiently answered, please feel free to write me at that email address as shown on this slide. If you have subscription concerns, call Sherry, 1-877-302-0749. She's there Monday through Friday, 9 to 5 p.m. Eastern Time. She'll be happy to take your questions as received on your doing with your subscriptions. If you do have a REIT question, then please send it to that email address there. I want to thank everyone once again for tuning into this presentation, and especially for being a member of our investment community and reading this service. I'm looking forward to our next presentation. It should be in about 6 months. We will have another REIT sheet out for you in 3 months. So stay well, everyone. Enjoy the spring, and I'll look forward to chatting with you next time.